When we talk about the bank that dared to make the biggest transformation, SCBx has to be hailed as the mothership of finance. They promised this colossal shifts from a traditional lender into a nimble regional technology company. But amidst the economic slowdown we've seen, did this mothership actually meet its profit targets for Q3 2025? Allowing its key high-growth subsidiaries like CardX and AutoX to expand as planned, and crucially, is its aggressive digital strategy really delivering that promised high-growth trajectory? Today, we are taking a deep dive into the future of SCBx. Hello and welcome to the Deep Dive. Our mission is really to cut through the complexity of this massive restructuring. We're evaluating SCBx's Q3 2025 fundamentals. We want to see if the bold vision is turning into reality or if, the mothership is still kind of tied down by traditional banking headwinds and regulatory caution. You need to know if this transformation is a genuine catalyst for breakthrough growth.
That tension, that pull between stability and breakthrough growth, that's precisely what the sources highlight. We have a fascinating stack of material for this deep dive. It covers the Q3 2025 consolidated results, yes, but it also lays out the detailed strategies for the subsidiaries. And there's the three-phase technological roadmap, plus analyst projections that look, well, pretty far into the future. It's important to note the timeframes here. While we're reviewing Q3 2025 results right now, the targets cited by the company and analysts, they often refer to the Thai calendar year projections. So we're talking about dates stretching out to what would be 2068 or even 2070 in that system. It just shows how long-term this transformation plan really is. What we're assessing today is whether the core bank's stability, that's the Gen 1 engine, can successfully fund the explosive, maybe riskier expansion of the digital lending and platform businesses, Gen 2 and Gen 3.
Okay, let's unpack this then, starting with the Q3 2025 results. The headline number looks strong. SCBx reported a consolidated net profit of 12,056 million banked for the quarter, and that translates to a solid 10.2% increase year on year. So compared to the same time last year.
Yeah, it looks good.
And over the first 9 months of 2025, the total net profit reached 37,344 million baht. That's an even higher growth rate, 15.8% compared to the previous year. That growth seems pretty impressive, especially given the macroeconomic climate.
The year-on-year growth is strong, absolutely. And it does seem to validate their strategic shift to, control costs and diversify income streams. But if we dig a layer deeper, here's where it gets, well, really interesting. We see a bit of a softening in the quarterly momentum. Q3 profits actually showed a sequential dip, about 5.7% compared to Q2 2025.
Okay. So up from last year, but down slightly from the immediately preceding quarter.
Exactly. It suggests that while they are managing to grow relative to last year, the immediate operating environment posed some, let's call it friction, in the third quarter. We need to figure out where that friction came from.
Okay, so let's look at the revenue drivers. The source material points directly to friction in the traditional banking engine, net interest income, NII, which is basically what they earn from lending. That dropped by a pretty substantial 9.9% year on year, totaling 29,413 million baht. Why such a sharp decline in the core business revenue?
Yeah, that NII pressure, it seems systemic, and it also reflects a cautious strategic choice they made.
Yeah.
There are really two main culprits here. First, a drop in the net interest margin, or IM. That squeezed the profitability on the loans they did have. That's largely down to policy rate adjustments and just market competition.
Okay, standard banking pressure.
Right. But second, and maybe more importantly, SCBx adopted a highly cautious lending approach. They prioritize quality over volume. They actually intentionally reduced their overall loan volume by 3.3%.
Wait, hold on. I have to challenge that a bit.
Yeah.
If the entire goal of this mothership restructuring is to enable high-growth subsidiaries, CardX, AutoX,
Right, the Gen 2s.
isn't the core bank, the mothership itself, intentionally slowing down the whole organization by shrinking its loan book? I mean, how can you be a high-growth company if your main source of lending revenue is actually contracting?
That is the core conflict you have to weigh as a listener, absolutely. It's a calculated risk management decision. The Gen 1 bank, the traditional part, is acting as the stable, conservative funding base. By intentionally, pumping the brakes on its own loan expansion, cutting loan volume by 3.3%, it drastically lowers the systemic risk for the entire group. So this sacrifice of short-term NII, it allows them to free up capital and, crucially, risk appetite to fund the riskier but potentially hyper-growth ventures in Gen 2 and Gen 3.
Okay, so the mothership is shrinking its hull, as you said, to make its rockets lighter and faster. Got it.
That's one way to put it, yeah.
So if NII is dropping, the mothership must have found other ways to compensate, right?
Yeah.
That must show the strength of that new structure. Non-interest income must have been pretty robust.
Absolutely. Non-interest income was the lifeline, really. It filled that gap. It grew by a very healthy 9.6% year on year, reaching 10,942 million baht. And the drivers here are critical because they speak directly to SCBx's success in managing, high-value clients and these non-traditional financial services. We saw exceptional growth in wealth management fees, apparently driven by strong demand for high-value investment products.
So the high net worth segment is doing well for them.
It seems so, yeah. SCBx is successfully capturing those advisory and management fees.
And we can't overlook the specific gains related to those high-risk, high-reward tech bets themselves, can we?
Exactly right. Revenue from investment and trading increased significantly, up to 3,326 million baht. And this wasn't just, traditional market trading. This was largely thanks to gains from the bank's own investment portfolio and the strategic ventures within SCB10X.
Their venture capital arm.
Right. So this shows the Gen 3 tech layer is already contributing meaningful revenue, which is, well, it's a powerful validation of the whole ecosystem concept they're building.
Okay, looking at the basics of execution, how did they handle operations? Tell us about their cost control and efficiency.
The operational efficiency is definitely a standout feature of the quarter. I mean, while undergoing this massive, usually expensive digital transformation, something that normally sends operating expenses through the roof, SCBx actually managed to tightly control its costs. Operating expenses decreased slightly by 0.2% year on year. That shows impressive cost discipline across the group.
But again, I have to push back a little. They're planning a complete cloud migration, building AI centers of excellence, aggressively recruiting top-tier tech talent. That stuff is expensive. Is a flat operating expense really sustainable for phase one of the transformation, or are they just delaying an unavoidable cost spike?
That's a perceptive question. Analysts seem to believe the flat cost base is sustainable, at least in the short term, and that's precisely because they are simultaneously implementing AI and process redesign to make the core bank radically more efficient. The cost-to-income ratio, a really crucial efficiency metric, it stood strong at 40.2%.
Yep.
This suggests they're funding the new tech investment partly through process optimization and automation savings in the core bank. They're essentially, cutting fat to build muscle.
Right. Makes sense. Finally, let's talk capital. This is the mothership's fuel tank, right?
The mothership's fuel tank is full. Yeah. Capital health remains impeccable. The statutory capital adequacy ratio, CAR, stands robustly at 18.9%.
Which is way above the minimum.
Significantly above the central bank requirement of 12%. This substantial capital buffer is their war chest. It serves two purposes. First, providing ultimate stability, and second, providing the regulatory freedom to fund those risky, high-growth Gen 2 and Gen 3 subsidiaries without worrying about compromising the core bank's stability.
Okay, this brings us back perfectly to that crucial structural pivot. We need to clearly articulate why this complex shift from the old SCB Bank to SCBx, the holding company, was so vital to this whole high-growth story.
Right. The structural shift was purely about managing risk and seizing opportunity. Think of the traditional bank, SCB, as the regulated battleship. It's stable, sure, but it's slow. SCBx, the holding company, allowed them to offload the high-velocity, consumer-focused businesses like CardX and AutoX into these Gen 2 and Gen 3 subsidiaries. This separation means these newer ventures can pursue high-risk, high-reward strategies.
Like unsecured digital lending or digital assets.
Exactly. Without the stringent capital requirements and regulatory oversight that would normally apply to the core commercial bank, it gives them more of a technology company mindset, kind of free of the traditional banking handcuffs.
But aggressive growth into unsecured and digital lending. That usually translates to higher risk. How did they manage asset quality in Q3, especially since they are now focusing on those, 20 million previously unserved customers?
This is perhaps the most impressive tactical success of the quarter, actually. SCBx successfully managed to improve its asset quality despite the economic pressures. The overall non-performing loan, or NPL ratio, actually decreased to 3.30% in Q3 2025.
Decreased.
Yeah, down from 3.38% the previous year.
That's counterintuitive. How'd they pull that off in an environment with policy rate cuts and cautious economic sentiment?
Well, the source material suggests this improvement is largely attributed to better risk management and portfolio quality control, particularly within the newly transferred portfolios, notably within CardX. And because the NPL risk was controlled, the company felt able to decrease its overall loan loss provisioning by 1.3% year on year.
Okay, so lower provisions.
Yeah, which is a sign that their initial data-driven underwriting models might actually be proving effective at selecting better quality borrowers than maybe a blanket traditional approach would have allowed.
So they felt confident enough to reduce provisioning, suggesting things are stabilized. But did they get complacent? Did they maybe purr back too much?
Absolutely not. This is a clear signal of prudence, I think. Despite the reduction in standard provisioning, management consciously set aside an additional 1,400 million baht in special provisions.
1.4 billion baht. That's huge.
It is, and this massive figure isn't for current losses. It's a specific, proactive, cautionary buffer designated purely for future economic uncertainty. They are essentially saying, look, the current numbers look good, but we know the future economy is shaky, so we're keeping a large safety net just in case.
Got it.
And this commitment to a high safety net is confirmed by the coverage ratio, which remains robustly high at 161.7%.
Okay, strong buffers. Let's connect SCBx's results to the broader banking sector for a moment, just to make sure we aren't overpraising an industry-wide trend.
Good point. If we look at the broader context, say the 8 largest banks, they collectively saw profit growth similar to SCBx, around 10.3% YoY overall. However, the critical point is that the system-wide challenge was identical. Net interest margin decreased across the board, mainly due to those policy rate cuts. So this confirms that the NII pressure SCBx experienced isn't some internal failure, it's systemic, driven by macroeconomic factors hitting everyone.
So the core industry mandate remains controlling NPLs and reducing costs, because principal business recovery is slow across the board. SCBx seems to be addressing these challenges not by waiting for the economy to recover, but by structurally insulating itself and moving towards a lower-cost, technology-driven operating model. Is that fair?
Precisely. SCBx is distinguishing itself by its focus on these structural changes. Instead of just, haphazardly cutting branches like some might, they seem to be implementing strategic cost management by fundamentally changing work processes using AI and innovation. They're aiming for a sustainable, lower cost-to-serve model, which is pretty essential to survive the sector-wide NIM and compression we're seeing.
Okay, let's shift gears now. From the Sable engine of today to the, astronomical goals of tomorrow. SCBx's aspiration isn't just to be a better bank, it's to become a regional financial technology company, a tech company, targeting a market capitalization of 1 trillion Baht and a customer base of 200 million within the next 3 to 5 years.
Yeah.
That's an exponential scale jump. It requires a whole new corporate philosophy, doesn't it?
It demands what the CEO calls the adoption of a technology company DNA. This means shedding that risk-averse culture you typically find in traditional banking. The new DNA has to stress the need to dare to experiment and, most critically, aggressively recruit top tech talent. They know that if they cling to the risk models and processes that made them successful as a bank, they'll probably fail as a technology group.
Right.
This requires funding disruption, which is exactly why that Mothership capital we talked about is so vital.
And their strategy for achieving this isn't just about shifting focus internally. It's fundamentally built on recognizing and responding to 3 massive global currents that are reshaping society, not just finance. Let's walk through those.
Okay. The first current they acknowledge is income inequality. Their response is centralized in the concept of financial inclusion. The goal is serving the estimated 20 million people currently excluded from formal credit access in Thailand. Their digital strategy isn't just about being faster, it's designed to fundamentally lower the cost of financial services. Through things like automated underwriting and low-cost digital delivery, this makes credit affordable for low-income groups where traditional banks could probably never make a profit.
Okay, current number 2, disruptive technologies, particularly blockchain. This one feels like it hits right at the heart of banking.
Oh, absolutely. And SCBx has taken a truly aggressive stance here. They recognize that blockchain technology aims not merely to reform traditional financial intermediaries, but potentially to replace them entirely.
Replace them? That's bold.
It is, and they're investing accordingly. They're building a complete vertically integrated digital asset capital market infrastructure. This isn't some small experiment on the side. This involves establishing all the necessary components. TokenX?
That's the regulated ICO portal for launching new digital assets.
Correct. Then there's the exchange for trading them, custody services to securely hold these assets, and brokerage, which is SCBx, their investment super app. They're essentially building the on-ramps and off-ramps for a future where capital markets might operate entirely outside of traditional physical exchange frameworks.
Okay, very ambitious. And the third current is the pivot that I think raises the most eyebrows for a major financial group. Environmental concerns or climate tech.
Yeah, this is where SCBx is placing a huge non-financial bet that could ultimately provide a unique competitive edge. They view the transition to net zero and the environmental focus as both a risk, stranded assets in polluting industries, and a massive opportunity. And the specific tactical application here leverages their lifestyle super app, Robinhood.
Right, the food delivery app. How does that become a climate tech play? Seems like a stretch.
It's actually quite ingenious, I think. Robinhood utilizes this massive fleet of drivers and delivery personnel, right? Most of whom currently use traditional pollution-heavy combustion vehicles. SCBx plans to help transition this entire fleet to all-electric vehicles, EVs.
Okay, but how? Drivers can't just afford EVs.
Exactly. They recognize that the average driver probably cannot afford the hefty upfront cost of an EV loan. So instead of traditional ownership debt, SCBx is exploring an EV subscription model.
Like pay-as-you-go for the vehicle.
Yeah, pretty much. This transition allows the driver to pay a manageable daily or weekly fee to use an EV. It reduces their financial burden, lowers their operational costs, and instantly boosts the mothership's commitment to sustainability credentials. It's an approach that merges financial inclusion, the shared economy model, and environmental goals all in one.
That kind of structural thinking really does define that tech company DNA they're talking about.
Yeah.
Okay, let's look at the concrete timeline. The three-phase, 5-year roadmap.
Right. This roadmap provides the structure for all this experimentation. Phase 1, years 1 to 2, infrastructure foundation. This is the foundational period. It absolutely must succeed for anything else to matter. They're establishing a center of excellence focusing on 3 non-negotiable areas. First, achieving complete cloud migration, getting all critical systems off those legacy expensive servers.
Makes sense.
Second, building robust AI capabilities for everything from customer hyper-personalization to advanced risk modeling. Third, and critically, cybersecurity. They explicitly state that cybersecurity risk is now viewed as equally important as credit risk.
Oh.
Yeah, recognizing that a breach in Gen 2 or Gen 3 could instantly compromise confidence in the entire group. They're also setting up international innovation labs to test new ideas safely outside the core regulatory environment.
Okay, that's phase 1, infrastructure.
Phase 2, years 3 to 4, growth and scaling. Once phase 1's infrastructure is proven, this phase is all about expansion. They'll leverage the new cloud and AI capabilities to massively scale the customer base and portfolio size of those high-growth Gen 2 and Gen 3 businesses.
Right, time to hit the accelerator.
Phase 3, year 5, value realization. This is the payoff. By year 5, the mature subsidiaries are expected to be proven platforms. This could lead to potential IPOs for the largest ventures and achieving unicorn status, billion-dollar valuations for key platforms like maybe SCBx or Robinhood. This value realization is what's intended to drive the stock's market capitalization toward that 1 trillion bet target.
Okay, to understand how phase 2 and 3 will execute, we need a clear list of the mothership's children, the generations of businesses, as they call them.
Right. The 3 generations are pretty distinct in their function. Gen 1, core stability cash engine. This is SCB Bank itself. Handles stable deposits, traditional commercial lending, and those crucial wealth management services. This gen is tasked with maintaining capital and efficiency. It's the foundation.
Got it, the anchor.
Gen 2, consumer finance digital lending. This is the high-growth risk engine. You've got CardX credit cards, personal loans, that's the flagship. Then AutoX title loans, branded money SIO, targeting lower-income individuals using vehicle titles as collateral. AlphaX luxury leasing for high-net-worth clients. And the dedicated digital lending apps like MONI, using the Finix brand, and Abacus Digital with Money Thunder. This whole group focuses on high-volume digital financial inclusion.
Growth engine.
Gen 3. Platform tech ecosystem. And these are the pure technology plays, offering services sometimes beyond traditional finance. InnovestX, the investment super app, aggregating trading across multiple assets. Robinhood, the lifestyle super app, focusing on shared economy and services. TokenX, the digital assets co-portal we mentioned. And SCB10X, the venture capital arm that fuels internal and external disruption.
Okay, that clarifies the structure. Now, the success of that entire 1 trillion Baht vision seems to rest really heavily on the execution execution of Gen 2, and specifically CardX. It's the flagship operation, managing the consolidated credit card and personal loan sectors after the restructure. If Gen 2 fails to execute its growth plans while controlling risk, well, the entire transformation thesis kind of collapses, doesn't it?
That's absolutely correct. CardX is explicitly leading the charge on that financial inclusion mission. They're not just targeting high-value customers, they're aiming to provide equal, fair access to credit for those 20 million Thai citizens. That's roughly 25% of the population, remember, who are currently locked out of formal financial institutions, often due to lack of traditional income proof or credit history. It's a massive addressable market, but yeah, it demands an entirely new approach to risk.
So how does CardX plan to enter this risky market, approve loans potentially within minutes, and simultaneously reduce NPLs, as they apparently managed to do in Q3? That sounds like they're trying to square the circle.
It is entirely dependent on technology. Their first and most important strategy is the heavy deployment of artificial intelligence, AI. They're investing massively in advanced AI analytics and alternative data models. So instead of relying only on traditional paperwork, the AI is trained to look at digital footprints, utility payment history, maybe transaction patterns within the Robinhood app, and other non-traditional data sets to assess creditworthiness.
What's the practical benefit of this AI model for that excluded population you mentioned?
The benefit is speed and personalization. It allows them to hopefully accurately assess credit risk for groups previously deemed sort of invisible. You know, the young, freelancers, small digital merchants, people who don't have regular traditional income slips. This predictive modeling is supposed to be so efficient that the goal is loan approval within 1 minute.
1 minute. Wow.
Yeah. For someone needing immediate financing for an unexpected emergency or maybe a small business expense, that speed is potentially transformative.
Okay, but how does the AI handle the inevitable risk that comes with unsecured lending?
Right, the AI works on both ends. It's not just an approval engine, it's also a mitigation tool. CardX uses what they call advanced preventive and repayment models. So if the economic climate worsens, the AI can analyze individual customer vulnerability and proactively personalize repayment schedules to maybe fit their capacity rather than just forcing a default.
Okay. Trying to work with the borrower.
Exactly. This aims to lower the long-term NPL rate by working with the borrower, which helps explain why they managed to reduce their overall NPL ratio in Q3, even while growing in these segments.
Okay, that's AI. Moving to the second core strategy, that massive investment in the digital platform and emerging technologies. You mentioned a 2 billion Baht commitment. What are they actually building with that?
They're building a system designed for exponential growth and, well, future-proofing. It's described as a fully cloud-native microservices architecture platform. Now, if we break down that jargon,
Please do.
cloud-native, it means they're building systems optimized specifically to run on the cloud. That enables cheap, virtually infinite scaling. If they actually hit 200 million customers, the platform supposedly won't crash or cost a fortune to manage. Microservices. Instead of one giant monolithic bank system, the platform is made up of many small, independent services.
So if one part breaks.
Right. If the credit card payment system, say, has an issue, the personal loan application system keeps running. This resilience is absolutely key for a tech company.
And they're building this with metaverse integration in mind. What does that actually signify? Is it just buzzwords?
It could be partly buzz, but it signifies a readiness for a potential Web3 or digital asset-heavy future. It means the platform is being prepared to handle things like identity management, asset transactions, and user experiences in virtual or digitally native environments down the line. The immediate customer focus, though, is on seamless, 24/7 hyper-personalization. They gave the example of their CardX chatbot, which is designed to anticipate needs rather than just answer reactive queries.
Okay. And finally, their third strategy centers on expanding the partner ecosystem.
Yeah, this is critical for driving usage and loyalty. You can build the tech, but people need to use it. CardX plans to expand its merchant network from over 100,000 currently to an additional 50,000 partners. And they're specifically targeting SMEs, digital merchants, and daily use services where the financially excluded population often transact.
So embedding it into daily life.
Exactly. By integrating CardX services into daily life, they hope to make the platform indispensable. Furthermore, they're developing Buy Now, Pay Later (BNPL) services, offering flexible payment options that further lower the financial barrier to consumption for people.
Okay, before we move on, we really must restate the massive targets CardX has set for itself. By the end of 2068,
Mhm.
right? That's the target year set by Kardex CEO Sarut Ratanaporn.
Yeah, these are staggering figures, and they absolutely underpin that 1 trillion Baht group valuation vision. Kardex is aiming for 10 million customers.
10 million.
6 billion Baht in net profit just from this single Gen 2 entity.
Wow.
And driving the group's total business portfolio growth to 150 billion Baht. If Kardex and, AutoX alongside it can actually hit these numbers, it really validates the Mothership strategy and could justify that valuation leap into the tech sector category.
The strategy is clear, incredibly ambitious.
Yeah.
But what does the market actually think of this multi-year high-risk plan? Let's look at the analyst consensus. CGSI provides a very positive outlook, apparently.
Yeah, CGSI maintains a strong buy recommendation. And they recently demonstrated confidence by upgrading their target price for SCBx to 148 Baht. Now, this is a critical figure because that target implies a price-to-book value, PBV, of 1.0x for their future valuation target year, 2068.
PBV of 1.0x.
Right. They also showed confidence in the operational trajectory by raising their earnings per share, EPS, estimates for the 2068-2070 period by between 1.8% and 7.6%.
Okay, let's talk about that PBV of 1.0x for a second. For our listeners, why is achieving a PBV of 1.0x so significant for SCBx?
Well, for a traditional commercial bank, a PBV of 1.0x is often considered, merely adequate, maybe even a bit low. But for SCBx, which is structurally transforming into this technology holding company, reaching 1.0x signals that the market is beginning to value the future high-growth subsidiaries, Gen 2 and Gen 3, more like tech ventures.
Right.
Rather than just discounting them as mere extensions of a traditional, slower-growing bank. It means the market is starting to believe the Mothership can successfully launch and scale those innovative rockets, to use your analogy.
Okay, makes sense. What's the core financial rationale for this analyst optimism, besides just the tech story?
It comes back to that capital structure we discussed earlier. SCBx maintains excellent capital adequacy, remember, CAR, near 19%. Crucially, this means the Mothership doesn't need to retain a lot of capital for significant, cautious loan expansion in Gen 1, because that segment is deliberately slowing down, as we discussed.
Okay, so if they don't need to retain capital for growth in the core bank, what's the consequence for shareholders?
Well, the expected consequence is a high return on capital and potentially high dividends. Analysts expect the return on equity, ROE, that measure of how effectively management uses shareholder money, to increase to somewhere between 9.0% and 9.5%. Furthermore, analysts forecast continued operational mastery. They expect the cost-to-income ratio to stay tightly managed between maybe 41.6% and 42.1% through 2070, which confirms the belief that technology can keep cost growth contained even as they expand into new areas.
Okay, let's jump to the dividend policy. This is often the anchor that attracts income investors to banking stocks, right? What's the policy and what are the forecast payouts?
Right. SCBx's official policy is a payout ratio of not less than 30% of consolidated net profit. However, in practice, management has been far more generous recently. Their actual payout sat at a very high 80% for both 2066 and 2067.
80% payout. That's high for a company investing so much in growth.
It is. And the excellent news for income investors, which is a major draw for the stock, is that CGSI forecasts this incredibly high payout of 80% to actually be maintained all the way through 2070.
Maintaining an 80% payout ratio, especially during a period of heavy technological investment, that's a powerful signal of confidence in the core bank's cash flow, isn't it? What kind of dividend yield does that actually generate for investors?
Well, that maintenance of the 80% payout leads to a projected dividend yield of somewhere between 8.2% and 8.9% per annum for the 2068-2070 period. To put that in context, the total dividend for 2067 was 10.448 per share. This high, stable, projected dividend yield acts as a fantastic safety net, potentially, for investors who might be concerned about the volatility of the Gen 2 and Gen 3 growth stories.
Right, you get paid pretty well while you wait for the tech transformation to mature.
Exactly.
Okay, turning to the market price. As of late October 2068, the latest price was 133.508, sitting near the high end of its 52-week range. Let's look at the technical trends cited in our sources. What are they showing?
Technical analysis from TradingView paints a bit of a nuanced picture. It shows momentum, but also maybe some caution is warranted short term. The overall technical rating is buy, and specifically the 1-month trend and the moving averages are signaling a strong buy.
Okay, positive momentum.
Yeah, this confirms that money flow seems strong, and the underlying trend suggests continued appreciation over the medium to long term, technically speaking.
But there's a short-term warning sign in there too, right? The oscillators gave a conflicting signal, a sell.
Exactly. That sell signal from the oscillators suggests the stock might be currently overbought or perhaps due for a short-term breather, maybe some consolidation, following its run-up near the 52-week high. It's an indicator that investors should perhaps expect some short-term profit-taking or sideways movement, even though the fundamental and medium-term technical outlook remains strong, according to these sources.
Okay. Finally, what are the primary risks and upsides cited by analysts looking out over the next, say, 3 to 5 years?
The downside risks seem to center almost entirely on execution, particularly within Gen 2. The key risk is higher than expected NPLs, especially from that aggressive unsecured lending targeted by CardX, and also potentially from residential mortgages, which remain sensitive to economic shifts. Lower than anticipated fee income, especially if that strong wealth management growth slows down, would also hurt the investment thesis.
And the upsides?
The upsides include successful execution of internal debt relief measures they might have, this successful realization of those cost reduction strategies, which Q3 showed some good progress on, and then external factors like increased tourist arrivals, boosting consumption, and supporting overall economic stability in Thailand.
Okay, so let's try and synthesize this complex deep dive. We have a mothership that is fundamentally stable, maintaining high capital, high efficiency, generating strong Q3 profits, driven by operational excellence and that non-interest income boost. This stability is deliberately being used to offset systemic pressures in net interest income, which are driven by cautious lending and rate cuts hitting the whole sector. And simultaneously, this mothership is aggressively funding a risky, multi-year technological transformation aimed at capturing massive new markets.
That tension between stability and risk is the core thesis, absolutely. SCBx has an exceptional foundation, high capital adequacy, tight cost control, and a clear, detailed, multi-phase commitment to digital assets and these new lending platforms. And that high dividend yield, projected to stay at an 80% payout, makes it undeniably attractive as a stable income play in the portfolio. It offers investors potentially a strong return while they wait for the transformation to play out.
But the critical question remains, does SCBx remain the banking reform leader, capable of delivering the breakthrough growth necessary to achieve that 1 trillion Baht tech valuation they're aiming for?
Well, the verdict hinges entirely on the execution of that technology roadmap we discussed. Success really hinges on phase 1 first. Can they successfully build the cloud, AI, and cybersecurity center of excellence on time and within budget without some sudden crippling cost spike? And maybe more practically, can Gen 2, led by CardX and AutoX, execute its ambitious growth targets? Remember, 10 million customers, 150 billion Baht portfolio, while successfully mitigating NPLs using its sophisticated AI models in what's still an uncertain economic climate. The market seems to have priced in much of this digital promise already, pushing that PBV toward 1.0x. Now, SCBx really has to deliver sustained operational success over the next 5 years.
The roadmap is clear, the capital is there, the strategy is definitely bold. But the final provocative element we explored, which is highly unusual for a major financial group, is their commitment to sustainability.
Yes, that focus on climate tech via Robinhood and the EV fleet subscription model, it's a very unconventional strategic differentiator. It forces SCBx to think beyond pure financial metrics and actually tackle societal issues like income inequality and environmental impact. For a company aspiring to be a regional tech leader, this focus on environmental, social, and governance factors, ESG, could be the non-financial element that truly sets them apart from their traditional banking peers.
So will this focus on sustainability and the shared economy truly be the differentiating factor that helps SCBx achieve its 1 trillion Baht valuation target, maybe outside of just pure financial metrics? Will it define them as not just a bank with technology, but a genuine, socially conscious regional tech company?
That's the ultimate question, isn't it? It's what the mothership's next 5 years will answer, and it's definitely what we and you need to watch. You know, it could create a new competitive advantage, attracting both the socially conscious customer base and maybe even the green funding sources that are becoming increasingly available globally. If they execute that pivot successfully, the market might reward them not just for their profits, but potentially for their purpose as well.
How was our in-depth look at SCBx? We hope this information helps you decide whether this mothership stock is right for your portfolio. If you have any questions or would like us to analyze a specific stock, please do let us know. Finally, don't forget to like, share, and subscribe to support our team. Thank you.